So, you've spent a lifetime building your retirement savings, right? But here's the million-dollar question. How do you actually turn that pile of money into a real paycheck you can live on? Well, today we're going to break down the single most important date that makes it all happen.
You've done the hard work. You've socked away the money. You've built up your retirement funds. But let's be honest, a lump sum just sitting in an account doesn't pay the mortgage or the grocery bill. The real challenge is, how do you transform it into a steady, reliable income stream you can count on month after month? It all starts with understanding that your money actually has two very different lives. You can think of your retirement savings kind of like a tree. For decades, you're in a growth phase. You're watering it, you're nurturing it, just trying to get it to grow as big as possible. But eventually, you need that tree to start bearing fruit so you can live off the harvest. And that is the income phase.
So, on one side, you have the accumulation phase. This is probably what you're most familiar with. It's all those years you spend working, saving, and investing. The number one goal is just to make your money grow. But then, on the other side, you have the distribution phase. This is when the tables completely turn, and your money starts paying you back.
Let's make this real. So, meet John. During his working years, he is smack dab in the middle of the accumulation phase. He's consistently putting money into his annuity, and that money is compounding, just growing bigger and bigger over time. His whole focus is on one thing: building that nest egg.
And this is Emily. She's now in the distribution phase. After all those years of saving and accumulating, she's flipped the switch. Her nest egg has been turned into a reliable monthly paycheck of $500 that she can use to cover her living expenses. So what's the big moment that separates John from Emily?
Well, the transition from John's world to Emily's world all comes down to one specific, incredibly important date. This is the date that literally flips the script on your retirement funds. And that moment is officially called the annuity commencement date. It's the date written right into your contract when the insurance company is legally on the hook to start sending you those regular, guaranteed paychecks. This date marks the official end of growing your money and the beginning of living off it.
Take a look at Carlos, for example. He was smart about this. He strategically set his commencement date for just 1 month after his last day at his job. And that simple bit of planning means there's no gap in his income. 1 month he gets a salary from his boss, and the very next, his annuity payments kick in. It's a totally seamless transition.
So, how do you actually choose that date? Well, it's not just about picking a random day on the calendar. See, there are different types of annuities, and each one has its own timeline. Let's look at the 4 main paths you can take to start getting paid.
Okay, this table here breaks down the 4 main options. First, you've got the SPIA. That's for immediate income. Then there's the DIA for income way down the road. The GLW is a flexible option that gives you a lot more control. And finally, the QLAC, which is a special tool for income very late in life. As we go through them, pay close attention to when the payouts start and what the big trade-off is for each one. All right, let's jump into path number 1, the single premium immediate annuity, or SPIA. This is for someone who needs income, like right now. You give the insurance company a lump sum and they start sending you checks within a year. It's simple, it's guaranteed, but here's the trade-off. It is irrevocable. Once you turn it on, that's it. You can't get your principal back. Path 2 is pretty much the exact opposite. It's the deferred income annuity, or DIA. With this, you're essentially buying a future paycheck. You might be 50 years old today and set your commencement date for when you turn 70. And because you're giving the insurance company your money for all that time, they can promise you much higher payouts later on. The trade-off? Your money is completely locked up. It is illiquid until that start date finally arrives. Now, path 3 offers more of a hybrid approach. It's called a guaranteed lifetime withdrawal benefit, or GLW. It's designed to give you that guaranteed income stream while still letting you keep control and access to your principal. You can often choose when to start the income, and your funds might even keep growing. The trade-off here? It's the cost. You pay an annual fee for all that flexibility. And our last path is a pretty specialized tool called a QLAC, a qualified longevity annuity contract. This is really designed for people who are worried about outliving their money and have big traditional IRAs or 401ks. You can use some of that money to buy a QLAC, delay the income as late as age 85, and here's the key, that money is taken out of your required minimum distribution, or RMD calculations. It's a powerful tool for late life income, but it does have limits on how much you can put in and, like a DIA, no liquidity. Okay, so before you even think about setting a date, there are a few really important rules of the road you have to be aware of, especially when it comes to the IRS.
Remember this number, 59 and a half. Seriously, this is one of the most important ages in all of retirement planning. And here's why it's so important. If you start taking withdrawals or income from your annuity before you hit age 59 and a half, the IRS can smack you with a 10% penalty on any of the earnings. It's their way of making sure you use this money for its intended purpose, long-term retirement savings. So yeah, timing is everything.
Now, how your income gets taxed depends entirely on where the money came from in the first place. If you used pre-tax money, from an IRA or a 401k, then every single dollar you receive is taxed as regular income. But if you used after-tax money from a savings account, a portion of each payment actually comes back to you tax-free, since it's really just you getting your own money back.
So after all that, it really all boils down to one final, very personal decision for you to make. It is the ultimate now versus later choice. Let's just summarize it. You should probably start your income now if you're retiring within the next year and you really just want certainty and simplicity. On the other hand, it makes more sense to start your income later if you've got time on your side, you want to maximize your future payout, or if you want that combination of income and continued access to your funds. Your own timeline and your goals are going to dictate the right path.
When it comes right down to it, the annuity commencement date isn't just some piece of financial jargon on a contract. It's the starting gun for your retirement income. It is the day that your years and years of saving finally actually transform into a paycheck you can live on. So the only question left is, are you ready for it?